Welcome back to the Deep Dive. Today, we're tackling something in financial statements that, well, even for pros, can sometimes feel a bit like a puzzle.
Definitely.
Those final adjustments, the ones made after the first set of numbers are down.
Exactly, the post-trial balance adjustments.
And our mission today is really to unpack these, maybe call them the unsung heroes. They make sure the company's financial story is, complete and actually true.
Absolutely critical. It's often where the real story is hidden in those adjustments. We're going to look at, I think, 5 main types today to help you understand not just what they are, but really why they matter so much.
And the fundamental point, the one we need to keep in mind throughout, is that every single adjustment hits both main statements, right?
That's the bedrock. Statement of profit or loss and statement of financial position. Every debit has a credit. It's all about balance and reflecting reality.
Fine-tuning the mirror, essentially.
Perfectly put. So today we're digging into inventory first, then accruals and prepayments. After that, interest, which has a slight twist.
Right.
Then depreciation. And finally, the one that often trips people up, irrecoverable debts and allowances for receivables.
Sounds like a comprehensive list. Ready to jump in?
Let's do it.
All right. Inventory. It's more than just counting boxes in the back, isn't it?
Oh, much more. Inventory adjustments are super common. The basic calculation for cost of sales is your opening stock plus what you bought.
Your purchases.
Right, minus your closing inventory.
And that closing inventory number, that hits both statements we mentioned.
Yes. It reduces your cost of sales on the profit or loss statement. That's a credit there. And it shows up as a current asset on the statement of financial position. That's the debit.
Okay, but here's where it gets more nuanced, I think. What about stuff that's damaged or just not selling?
Yes. Here's where it gets really interesting. You absolutely have to adjust for that. There's an accounting standard, IAS 2.
International Accounting Standard 2.
That's the one. A key global rule. It says inventory must be valued at the lower of its original cost and its net realizable value.
Net realizable value meaning what you can actually sell it for minus selling costs.
Exactly. What you expect to get for it in the end.
So that stops companies looking better than they are, essentially. Prevents overstating assets and profit.
Precisely. It's a prudence measure.
Can we walk through a quick example?
Yeah.
How does that write-down actually work in the numbers?
Sure. Let's say you've got some inventory. Cost you $10,000.
Okay.
But maybe it got damaged or fashion changed, whatever. Now you only expect to sell it for $5,000.
Right.
You have to reduce your closing inventory figure by that $5,000 difference. So maybe your total inventory count came to $45,000 initially. After this adjustment, you'd report it as $40,000.
And the knock-on effect.
Well, that $5,000 reduction in closing inventory increases your cost of sales on the profit or loss statement.
Reducing profit.
Reducing profit. And it lowers the inventory asset value on your statement of financial position. Without that rule, you could be showing phantom assets and profit.
Very clear. Okay, so if inventory is about what you have, the next adjustments, accruals, and prepayments are all about when, aren't they? Timing is everything here.
It really is. The core idea, the accruals concept, is fundamental. Your profit or loss statement has to include all the expenses and income that relate to that period.
Regardless of whether cash is actually moved.
Exactly. Regardless of payment. It's about matching the economic activity to the right time frame, not just tracking the bank account.
So what's the practical difference then between an accrual and a prepayment?
Okay, so an accrual is for something you've used or incurred in the period but haven't paid for yet.
Like the electricity bill for December that arrives in January.
Perfect example. You've used the power, so the expense belongs in December. That unpaid amount becomes a current liability on your statement of financial position, an accrual.
And prepayments.
The opposite, really. You've paid for something in advance that benefits a future period.
Like paying your business insurance for the whole year up front.
Exactly. If your year end is December, but you paid the insurance premium in November to cover the next 12 months, part of that payment relates to next year.
So that part becomes an asset.
Right. A current asset.
Yeah.
Because you've essentially bought a future benefit. You prepay it.
Let's use the examples from our sources to make it concrete. Wages first.
Okay. Say the trial balance shows wages paid of $136,000.
Right.
But there's another $3,800 owing to staff for work they did in this period, but they haven't been paid yet.
So the actual wage expense for the profit and loss statement is higher.
Correct. It needs to be the full $139,800, and that extra $3,800, that sits on the statement of financial position as a current liability, an accrual.
And the insurance example.
Similar logic. Trial balance shows, say, $4,000 paid for insurance. But doing the analysis, you figure out $600 of that actually covers the next financial year.
So the expense for this year's profit and loss statement is only $3,400.
Precisely. You only expense the part that relates to this period. And the $600 paid in advance, that's your prepayment, a current asset on the statement of financial position.
It's all about that matching principle, getting the right costs and revenues in the right period.
Spot on. And just quickly, it works the same way for income too. Income received in advance before you've earned it. That's a liability deferred income. Income you've earned but haven't received the cash for yet. That's an asset accrued income.
Got it. Okay, moving on. You mentioned interest having a twist. How is that different from, say, the wages accrual we just talked about? It sounds like another timing thing.
It is an accrual, fundamentally. But the twist is sometimes you're just expected to know you need to accrue for it. The information might not explicitly say accrue interest.
So you had to infer it from other information.
Exactly. It's a common exam technique, but also reflects reality. If you see, say, $100,000 of 8% loan notes on the trial balance, and the interest paid figure only shows $4,000.
But 8% of $100,000 is $8,000 for a full year.
Precisely. So if that loan has been outstanding for the whole year, you're expected to figure out that another $4,000 of interest has accrued but hasn't been paid.
You have to calculate it yourself and make the adjustment.
Correct. Apply the rate for the period the loan was active.
So let's trace that $8,000 total interest and the loan itself through the statements. Where does it all go?
Right. The total interest expense for the year, the $8,000 in our example, goes into the statement of profit or loss. Reduces your profit.
Okay.
The accrued portion, the $4,000 that's owing but unpaid, that becomes a current liability on the statement of financial position.
Separate from the main loan.
Yes, usually shown separately.
Yeah.
And the loan principal itself, the $100,000, that typically remains as a non-current liability, assuming it's a long-term loan.
Okay, that makes sense. Keep the unpaid interest separate from the capital amount.
Exactly. Transparency is key.
Right. Next up, depreciation. Spreading the cost. This feels like another application of that matching principle we discussed.
It absolutely is. Depreciation is all about allocating the cost of a non-current asset. Think buildings, machinery, vehicles over its useful economic life.
So you're matching the expense of using the asset against the revenue it helps generate each year.
That's the core idea. Instead of expensing the whole cost when you buy it, you spread it out.
And there are different ways to calculate this spread, aren't there? What are the main methods?
The two big ones are straight line and diminishing balance, sometimes called reducing balance.
Okay, straight line first. Sounds simple.
It is. You take the cost of the asset, maybe deduct any expected scrap value at the end, and divide it by its useful life in years. Or just apply a fixed percentage to the cost each year.
So the depreciation expense is the same amount every single year?
Yep. Predictable, like 20% per year for 5 years.
And diminishing balance, how's that different?
With diminishing balance, you apply a fixed percentage, but you apply it to the asset's carrying amount.
Carrying amount being cost less, the depreciation already charged in previous years.
Exactly. Cost less accumulated depreciation, so the depreciation charge is higher in the early years and gets smaller over time.
Why use that method? Seems more complicated.
Well, it arguably reflects reality better for some assets. Think about a new car or computer. They lose value much faster initially. This method matches that pattern more closely.
Right. So the bigger expense hits when the asset is newest and perhaps most productive.
That's the theory.
And companies choose which method to use and stick to it.
Generally, yes. They'll have a depreciation policy. That policy also dictates when depreciation starts. Some charge a full year's worth in the year they buy the asset, regardless of the date.
Even if bought in the last month.
Yes, and then none in the year they sell it. Others are more precise and use a pro-rata basis charging depreciation for the actual number of months they owned the asset in the year.
You really need to check the company's specific policy then. I remember hearing about a company just before they were acquired, actually.
Yeah.
They changed their depreciation method, switched from diminishing balance to straight line for a load of assets, made their profit look significantly better that year.
Wow. That's a perfect example of how these technical choices can really influence the numbers people see. It highlights the importance of understanding the policies behind the figures.
Definitely. So how does this all show up on the actual statements? Where do we see the depreciation charge versus the accumulated total?
Good question. In the statement of profit or loss, you only see the depreciation expense for the current year, just this year's slice.
Not the running total.
No. The running total, the accumulated depreciation over the asset's life so far, impacts the statement of financial position.
How so?
On the statement of financial position, you show the non-current asset at its original cost, less the total accumulated depreciation up to that date. The result is the asset's carrying amount or net book value.
Okay, so PL gets the year's charge. SFP shows the cost less the total charge to date.
You've got it.
And what about when the asset reaches the end of its life or the company sells it? How do we handle getting it off the books?
That involves a specific process, usually using what's called a disposal account. It's like a temporary clearing account.
Okay.
When you sell an asset, you take its original cost out of the asset account and put it into the disposal account as a debit.
Right.
You also remove all the accumulated depreciation related to that specific asset from the accumulated depreciation account and put that into the disposal account as a credit.
So the disposal account now has the asset's carrying amount in it, effectively.
Exactly. Then you record the cash you received from selling it. The sale proceeds into the disposal account as well, another credit.
And the balance left in that disposal account tells you.
Whether you made a profit or a loss on the sale. A credit balance means a profit. A debit balance means a loss. That profit or loss then gets transferred to the statement of profit or loss.
Okay, so it clears the asset off the balance sheet and recognizes any gain or loss from selling it.
Precisely. A quick check is just proceeds minus carrying amount at sale date equals profit or loss.
Makes sense. Right, final section. The one our sources flag as often being the trickiest. Irrecoverable debts and allowances for receivables. Dealing with customers who don't pay.
Yes, this area definitely requires careful handling. Let's break it down. Two distinct things here. First, irrecoverable debts or bad debts.
This is when you know for sure a specific customer isn't going to pay.
Pretty much. You've maybe exhausted collection procedures or they've gone bankrupt. It's clear the debt is gone for good. You're writing it off.
And what's the accounting impact of writing it off?
It hits the statement of profit or loss directly as an expense in the period you write it off. Reduces profit.
Okay.
And on the statement of financial position, you reduce your trade receivables balance by that specific amount. Plus, you update the customer's individual ledger account, of course.
So that debt is completely removed from the main receivables figure.
Correct. Now, the second part is the allowance for irrecoverable debts, sometimes called allowance for receivables.
How is this different from just writing off a specific bad debt?
The key difference is the allowance is an estimate. You're not writing off specific debts yet. Instead, you're looking at your total receivables and estimating how much, overall, you think you might not collect in the future.
So it's more of a general provision based on past experience or current conditions.
Exactly. It aims to show a more realistic value for your receivables on the statement of financial position. It's applying prudence again. Importantly, the individual customer debts remain on the books, so you can still try to collect them.
Okay, so you're adjusting the overall value shown, not specific customer balances yet.
Right. Let's use an example. Say your total trade receivables are $180,000, and you had an allowance brought forward from last year of $4,000, so your net receivables were showing as $176,000.
Okay.
Now, based on reviewing the debts, maybe talking to the credit control team, management decides the allowance this year should be $5,400.
So it needs to increase by $1,400.
Exactly. Now, here's the crucial part for the statement of profit or loss. You only charge the increase in the allowance as an expense.
So only the $1,400 hits the PL as a bad debt expense, not the full $5,400.
Correct. The PL only reflects the change needed in the allowance during this period.
That's a really important distinction. And on the statement of financial position.
There, you show the trade receivables net of the new total allowance.
So it would be $180,000 minus the full $5,400.
Yes. Showing a net figure of $174,600. It reflects the most up-to-date estimate of what's actually collectible.
Giving users of the accounts a more realistic view of those current assets.
That's the goal.
And just quickly, what if the seemingly impossible happens and a debt you already wrote off actually gets paid later?
The recovery. Good point. If that happens, you'd record the cash coming in, debit cash. And the credit would usually go against the irrecoverable debts expense account, effectively reducing this year's expense.
Or maybe a separate income account.
Some companies do use a specific irrecoverable debts recover account, yeah. Either way, it reverses the impact of the earlier write-off. Brings the cash back in.
Phew. Okay, that was quite the journey through those adjustments.
It was a proper deep dive.
We really covered the key ones. We looked at inventory, making sure it's valued correctly, dealing with damaged goods, using that lower of cost and net realizable value rule. Then accruals and prepayments, all about timing, matching expenses and income to the right period, not just when cash flows.
Yep, the accruals concept.
We saw how interest can be a kind of silent accrual you need to calculate.
The inference required there.
The depreciation spreading asset costs, the different methods like straight line and diminishing balance, and how disposals are handled.
Getting assets off the books correctly.
And finally, we navigated irrecoverable debts, writing off specific bad debts versus creating that general allowance for receivables to show a more realistic overall picture.
Covering the spectrum of common adjustments.
And tying it all together, understanding these isn't just about ticking accounting boxes, is it?
Not at all. When you, the listener, grasp these adjustments, you can look at financial statements quite differently.
How so?
You start to see beyond the surface numbers. You understand the judgments and estimates involved. You appreciate the principles like matching and prudence. It helps you get a much richer, more accurate sense of what's really going on in the business.
That's the aha moment, right? Seeing the full story, not just the headline figures.
Exactly. Which actually brings up an interesting final thought. Well, we've seen businesses have choices, haven't they? Choices in depreciation methods, choices in how generously they set their allowance for receivables, maybe even how they value inventory within the rules.
Those policy choices.
Right. So how might these seemingly technical accounting decisions subtly shape the narrative? How might they influence what investors or lenders or even the public perceive about a company's financial health, its profitability, maybe even its stability?
Interesting. How the mechanics can influence the message.
Something to think about until our next deep dive.